Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about AVERY DENNISON CORP quarterly report. Avery Dennison Corporation offers a diverse range of businesses and services across various industries. These include pressure-sensitive label materials, papers, plastic films, metal foils, performance tapes products, mechanical fasteners for automotive, industrial, and retail applications, graphics and reflective products, films for architectural, commercial sign digital printing markets, durable cast and reflective films, construction, automotive fleet transportation markets, branding solutions, brand embellishments, graphic tickets, tags, labels, sustainable packaging, information solutions, item-level RFID, visibility and loss prevention, price ticketing and marking, productivity and media, brand protection and security. The company serves industries such as home and personal care, apparel, general retail, e-commerce, logistics, food and grocery, pharmaceuticals, and automotive. Avery Dennison Corp's stock price drop. A multifaceted issue the past year has seen Avery Dennison Corp's stock price plummet by over 11.35%, with some reports indicating declines as high as 22–28%. Several factors have contributed to this decline, including the company's underperformance relative to the broader market. In 2025, Avery Dennison's fundamentals weakened, with a slip in revenue and profitability despite effective cost-cutting measures. The market may have anticipated an increase in revenue, leading to investor disappointment when flat revenue performance was reported. Broader economic and market risks, such as global economic conditions, political uncertainty, and fluctuations in raw material costs, have also contributed to investor caution. While quarterly earnings reports have shown positive results at times, the significant drops occurred during periods of negative sentiment and fundamental concerns. The stock's 52-week low of $156.26 in October 2025 reflects a 28.37% decrease over the preceding year. The primary drivers of revenue growth or decline can be identified in the financial summary. Revenue growth is primarily driven by organic sales changes, high single-digit rate increases in high-value categories, and significant growth in the materials group and solutions group. On the other hand, revenue decline is attributed to several factors, including raw material deflation-related price reductions, losses from Argentine peso revaluation, higher incentive compensation payments, changes in operational working capital, higher tax payments, and higher trade rebate payments. These drivers indicate that revenue growth is largely driven by internal factors such as sales performance, while revenue decline is influenced by external factors like market conditions and exchange rates. Net income and profit margins decline due to various factors. The company's net income decreased by $9.3 million, or 1.8%, from $530.9 million to $521.6 million. This decline is attributed to several factors, including higher employee-related costs, pricing and raw material input costs, and increased tax payments. The profit margins also suffered due to these reasons. In the Materials Group segment, adjusted operating income as a percentage of net sales decreased, while in the Solutions Group segment, it also declined. Higher incentive compensation payments, changes in operational working capital, and higher trade rebate payments further contributed to the decline in net income. The company's growth investments and raw material deflation-related price reductions had mixed effects on its financial performance. Overall, the decrease in net income and profit margins can be attributed to a combination of these factors, which impacted the company's bottom line. Based on the financial summary provided, it appears that the company is struggling with its cash flow management. Specifically, the company is generating negative operating cash flow, which indicates that it is not producing enough cash from its core business operations to cover its expenses and investments. This situation can be a concern for investors and stakeholders, as it may indicate underlying issues such as inefficient operations, high debt levels, or poor financial planning. To address this issue, the company may need to implement cost-cutting measures, improve its pricing strategy, or explore alternative financing options to generate more cash from its business activities. Overall, the negative operating cash flow suggests that the company is not generating sufficient positive cash flow from its core operations, which can be a significant challenge for its long-term sustainability and growth. The company's debt level has experienced significant growth over the past year. According to financial summaries, total debt increased by approximately $600 and $42.4 million, $700 million, and $629 million from various periods. This substantial increase suggests a notable rise in debt. Regarding interest expenses, there is evidence of an upward trend. Net income decreased by $9.3 million from 2024 to 2025, implying higher interest expenses. Additionally, the company's third-quarter interest expense increased due to €500 million senior notes issued in November 2024. The interest expense also rose from $87.8 million in 2024 to $98.2 million in 2025. Overall, both debt level and interest expenses have shown significant changes over the past year, indicating a notable increase in financial obligations for the company. The company's financial performance varied across different segments and regions. Notably, the materials group excelled in Europe, the Middle East, and Africa, with a significant increase of $21.7 million from 2024. Additionally, Solutions Group's Identificati and Vestcom segment saw an improvement of $13.5 million. However, several regions struggled due to various reasons. Countries such as Argentina, Afghanistan, Syria, Iraq, Yemen, Iran, Turkey, North Korea, Bangladesh, and Israel experienced poor performance, largely attributed to civil disturbances or ongoing conflicts. The European Union's tariffs and trade policies also had a significant impact on sales in this region. Management is optimistic about the company's outlook, expecting an increase in net sales in Q4 2025 due to favorable foreign currency translation. They are also investing in growth initiatives, such as information technology upgrades in the U.S. and venture investments, which will partially offset cost reduction efforts. The company aims to optimize its operational footprint through restructuring actions, resulting in incremental savings and benefits from productivity initiatives. In terms of financial strategy, management plans to use commercial paper borrowings to fund debt repayment, dividend payments, share repurchases, and capital expenditures while maintaining an investment-grade rating. They are also focusing on managing debt levels and maintaining access to commercial paper markets. Overall, the company is committed to growth in key regions such as Asia-Pacific and the U.S., with investments in equipment and buildings to support this expansion. The company's financial summary reveals that it has engaged in two key shareholder return initiatives. Firstly, the company has a history of paying dividends to its shareholders, as documented on page 12 under the Dividends section. Secondly, the company has also implemented share buybacks, with evidence found on pages 12 and 30, specifically in the share buyback and share repurchases sections respectively. Concerns over inventory buildup and supply chain disruption, the company's financial summary highlights two pressing concerns that warrant attention. Firstly, the risk of supply chain disruption is acknowledged on page 33, indicating potential vulnerabilities in the company's logistics and distribution networks. Furthermore, an increase in inventory buildup across various categories, raw materials, work in progress, and finished goods, has been noted on page 18. This accumulation of stock can lead to wasted resources, reduced cash flow, and decreased efficiency. Addressing these issues is crucial to maintaining a healthy supply chain and optimizing business operations. That concludes the financial summary for AVERY DENNISON CORP. Feel free to comment below, and I will be happy to answer them when possible.